Hello everyone. So after some time I'm back with another tutorial. Today it will be on backtesting trading strategies in Python. And this is a completely different video from what I did before. But I think it's actually quite practical and it can help a lot of people to implement their own ideas when it comes to trading, and mainly it allows them to test whether a particular trading strategy would be successful or not. First of all, I would like to say that there are already quite a lot of solutions that do exactly this, that they test whether a particular trading strategy would have performed in the past well or not. But I just want to give you some ideas about how you can write your own backtester, because I just think it's always much better if you write the code on your own, because then you are very solid about what the code is doing, how the strategy actually works, and it's not that you just push some inputs into some black box and then it generates some outputs. But here you really need to think about what you're doing and make sure that you really understand the trading strategy. If you really wanted to go with some ready-made solution, I think the most heavily used solution is actually a zipline, which is a tool developed by Quantopian, and it's very complex. It can do a lot of things for you, but I actually don't use it that much because I just don't like the way you need to set it up and so on. And so it's not really friendly to the latest Python version. So you have to go with some older Python version. You have to create some virtual environment and so on. So I just prefer to write my own backtester because I then have a complete freedom about what the trading strategy and the trading model should do. So this is just an idea about what you can use as alternative, but the focus of this tutorial will be on your own backtester. I'm also choosing Python this time because I believe Python is really strong when it comes to handling of time series and financial data overall, especially in combination with this pandas package where you have these objects like data frame or series. It's really well suited for financial data. So I will stick with Python. Let's talk about the trading strategy we are going to backtest here. So this is just an illustration. You don't really need to follow the strategy. It's just to give you an idea about the particular idea to trade, and then of course you can just adjust your backtester to test any other strategy that you like. I'm just giving you the concept here. So the idea is really to go with what is usually called low volatility trading. That means we are going to hold S&P 500 ETF. ETF is exchange traded fund, and it's basically tracks the performance of S&P 500 when the volatility is low. So here we have to be a bit more specific about what does it mean low volatility, and also we need to add what is the trading strategy going to do when the volatility is actually high. So I will just for completeness add when vol is high, be in cash. So in other words, we just don't want to be in the market when the markets are nervous. We just want to trade this like stable growing market, and this is where we just gonna hold this S&P 500 ETF, whose symbol in the market is SPY. There are more other trackers, but SPY is the most frequently used one. And then we also need to define what does it mean low volatility, or how do we define the volatility here? You can write your own code to calculate volatility of let's say this S&P 500, but here we will just stick with a simple solution. We will already use the calculate volatility, or let's say publicly available volatility, and the volatility we will use a volatility index for that, and we will use VIX. They also call it fear index because it really measures the volatility in the market. It measures some implied volatility of options, blah blah blah, but we don't really need to go into details right now. If you want to read more about this, go ahead. I think there's a lot of information on the internet about VIX. So in other words, we are going to hold S&P 500, hold SPY if VIX is low, otherwise be in cash. Okay, so I have just rephrased this trading strategy into some more specific version of that. The idea is really simple. Let's see how it performs after we implement the backtester. And of course, because it's a model, and I just want to keep the thing simple, there will be some assumptions. So one of the assumptions I already mentioned, we will just use VIX index to represent the volatility. You can just go here and you can see that today the volatility is roughly 33%. And you can see how, if we have a look at this closed or adjusted closed columns, you can see how the volatility behave in the, let's say, previous month. In the latest month, you can see that because of the coronavirus, the volatility really went up, and now it's decreasing a little bit. Sorry, I just had it sorted in a different way, but you can see that it was about 60, 70, 80, and now it's going down again. So the markets are becoming less nervous. Let me just go back to the to the Word file, to the assumptions, and so this is explained. We'll assume that there are no transaction costs. You can just implement this feature very, very easily depending on what kind of broker you have. But for simplicity, I assume no transaction costs. We also assume that you can just buy a fraction of the ETF. That means, you can buy, let's say, 22.37 pieces of ETF. You cannot do this in practice. You can only buy 22 or 23. But for the simplicity, or for the sake of simplicity, we'll be just assuming that you can buy also a fraction. It's just a convenience assumption. And also we'll be assuming that you can trade only once per day by the end of the trading session. So this is also a convenient assumption. It just allows us to perform the backtest on closing prices. So we can ignore anything that happens during the day, and we can just have a look at the closing prices. What will we need? So we will generally be downloading data from Yahoo Finance because they can be very easily downloaded through Python. And to allow your Python to download the Yahoo data, you need to have a package called Pandas Data Reader. It doesn't come with Anaconda, so you need to install it manually. So just copy this command to your command line and run it, and it will install Pandas Data Reader. And when it comes to the structure of our code, we will just first of all write simple function that will download market prices from Yahoo Finance, and then we'll be implementing our backtesting function, which can be broken down into 3 subpoints. So first of all, we'll just define some objects, some data frames that will store our trading positions. Then we will go day by day through the historical period, and we will just apply the trading rules. And eventually, we'll just generate some final results. And we'll also compare our trading strategy to a benchmark. This is incredibly important because your absolute performance eventually doesn't matter that much. Well, it does matter. Of course, you want to end up with a positive number at the end when it comes to trading. But you also want to know whether, just putting the money somewhere wouldn't have been better. That means you are comparing with the benchmark. As a benchmark, we will use S&P 500 as most of the traders out there. And yeah, that's pretty much it. Before we start to implement the code, I will just give you a short example how such a trading could look like. So here we have a couple of days, 12 days, and we have the prices. These are prices of the S&P 500 tracker. Just like this. And we are going to buy this or hold this only when the volatility represented by the VIX index is low. For the purpose of this example here in Excel, I have just chosen a threshold of low volatility to be 40. Yeah, it's fairly high threshold, to be honest. In practice, we would be more comfortable with the lower number, but this is just an example. You also see eventually that our portfolio is decreasing when we apply this threshold. But like I said, this is just an example. So how the strategy would look like? The colors orange means that we'll be in cash, because if VIX is over 40, we just don't want to hold any market position. We just want to be in cash. So by April 13, the volatility is above 40, so we just do nothing. We hold our cash position. But the next day, the volatility has decreased to only 37, and then we just gonna buy the S&P 500 tracker. So for 10K, we can buy 35.24 pieces of this tracker. And the next day, by the end of April 15, we just see that the volatility is high again, and we no longer want to have that. We no longer want to hold that S&P 500 tracker. So we are going to sell it. So we will cash our position. So we will sell those 35.24 pieces of the tracker at the closing price of April 15, and that will be our cash position, and so on and so on. So we go day by day like this, and we see here, unfortunately, our portfolio value is decreasing in value, but this is, first of all, very short window where we backtest. We should backtest over maybe 20 years. You really want to see the complete picture. You just don't want to see trading within 2 weeks or so. And the second point is that I set the threshold very, very high so that I can demonstrate how the actual mechanics works. And in reality, you might be more comfortable with a lower number here. So in other words, you just don't want to hold any position when the volatility is too high, right? So you might want to say, okay, when the volatility is just 30 and more, then be in cash. And in that case, if I set it to 30, then we would be in cash all the time here, because the market is still quite nervous. In any case, I hope that you get the main idea here, and we will just transform this idea into some Pythonic code. And then, of course, you can always change the elements of the code. You can make it more general. You can implement other ideas, and so on and so on. This is just to illustrate the approach. All right, so let's go to Spider. Yeah, you can use any IDE that you like. I just prefer Spider because we have this variable explorer here, which I find highly useful for exercise such as this one. But you can just be fine with Jupyter Notebook. So first of all, we will import pandas. SPD is the usual start. And then I'm going to copy paste a function that you're gonna use for download of the data. So basically, this function loads the market data from Yahoo Finance and stores the resulting data as a pandas data frame. It's very easy to use. We just want to say prices. I will give you an example. Prices, load, equities, web. And we are going to download S&P 500 tracker, which has a symbol SPY. If you don't know what kind of symbol to use, please go to Yahoo Finance and you can always search for what you want. Here it already tells me that SPY is the S&P 500 ETF. You should always read more details about it, but I know this tracks S&P 500. So it goes up by 0.38% today. If I have a look at S&P itself, which has this symbol GSPC with the head, yeah, it's nearly the same performance. All right, so I'm gonna go back to Spider, and we are going to download SPY. Then we are going to download the S&P 500 itself, GSPC, and we are also going to download VIX. Anything that is index, such as S&P 500 or the VIX index, has always this head as the initial character there. And we also need to define from which day to download the data. So let's go fairly back to the history and let's download data from the beginning of 2000. So date from is equal to beginning of 2000, like this. And let's run this and let's see what it gives. All right, and you can see that we have just downloaded 20 years of data. The data seems to be of a pretty good quality, quoted every day. If you just wanna, I highly encourage you to just make a quick check if the data is complete. So we are going to do prices. It's not a number and sum, so it is going to tell us how many missing values we have. We have apparently no missing values. This is perfect, so we don't need to do any kind of other hacks to backfill the data. But you should of course do this when you are trading some, let's say, less liquid ETFs or equities, because there you will for sure have some missing data. But luckily in this case we have no such cases. And okay, so this is done, and now we are going to proceed with the backtesting function. So we are going to define backtest strategy. The first argument will be the data frame with the prices. Then we have to give it a symbol that we are going to trade. So in our case, it will be, according to the definition of our trading strategy, we'll be trading SPY. We need to have symbol for the volatility. So it will be another variable, symbol volatility. So in our case, this symbol volatility will be this hat VIX. Then we need to define volatility threshold. Yeah, remember that, recall that we said that we are going to trade the SPY when the volatility is low. So that means we need to have some threshold which defines what's a low volatility. Yeah, we start with some initial capital. That's our cash position when we just start trading. And it's also handy to have symbol benchmark. Okay, so this will be the symbol of the equity or index that we just want to compare our strategy to. So we will be comparing our strategy to S&P 500 performance. So yeah, it will be stored in this variable. All right, so now we can write the body of the function. The way I will do it is I will define 3 data frames. One data frame will hold positions by the beginning of trading session. I will call it init, so df init. It will be something. Then I will have data frame that will be df update. So update basically means what kind of trading activity did I do by the end of the day, and df end will be just the position that I will be holding by the end of the day. So the difference between the positions at the end of the trading session and by the beginning of the trading session will be reflected in the df update. The update means the difference between the initial positions by the beginning of the trading session and the final positions by the end of the trading session. You can absolutely write a much better, more efficient code, but the code that I show here is more to show you the individual pieces that you need to think about when you implement the trading strategy backtester. It's not going to be the fastest code. It's not going to be really very efficient, but it will just do its job. And I think that's what most of us care about, whether it's doing the job. Okay, so what we are going to do here, we will define simple data frame, which will just be quite similar to our prices data frame, but we just wanna have it empty, so with no values. So the easiest way to do this is to write symbol trade times 0. So whatever is in prices in a column with symbol trade will be just multiplied by 0. So eventually we'll get a series of zeros. Then we will make this data frame. So we'll go to frame, and we also want to have a column called cash, because we don't only want to know how many ETFs or stocks we hold. We also want to know how big is our cash position by the initiation of the trading session. So we're going to write assign cash is equal to 0, and we'll do the same for all these objects because they will look exactly similar before we start to fill them with data. All right. So now we just need to insert our money to the trading account, so to say. So what we are going to do is that we will add some initial balance to the to these two data frames, init and update will be still having zeros because update is just the difference between init and end. Let me maybe, before I do that, let me just show you. Okay, let's just turn 0. It's just temporarily to return some value before we fully implement the body of the function. Let me just put a breakpoint here because I just want to show you what actually these objects look like before we start to add some data, before we start to fill in some data. So let's press. By the way, this has been added I think since Python version 3.7. So if you have older Python version, this command will not work or might behave differently than in my case. But I really recommend using this breakpoint function because it's just so useful when you want to explore your code. Okay, so prices we have defined here. Symbol trade will be in our case. So prices are just simply prices. Symbol trade will be SPY. Symbol volatility will be X. Volatility threshold, let's do 30. Capital, let's do 10K. And symbol benchmark will be GSPC because we want to compare our trading strategy to S&P 500 performance. Okay, let me run this. Let me run this line, and now we are already in the code, and we can see what happens. So we have 3 data frames. We can have a look at how they look. So they look just like prices when it comes to this column, only that the column is at 0 because it holds number. It represents the number of pieces of the SPY that we are going to hold, and this column represents how much cash we hold. In this case, by the beginning of this date, yeah, because it's initial DF in it, so it's the initiation of the trading session. What we want to do is that, I'll go back. We are going to basically, the first day, we are going to just add money to our trading account. So we are going to hold the capital, this variable here and here. We just don't trade the first day. No, we just keep the thing simple. The first day we'll just add cash. Okay, so let's do this. DF init. I look 0. So the first or zeroth row, and a column called cash. So then we need to define df init columns get lock cash is equal to capital, just like this. And we will do the same with df end. And okay, and let's see now how it looks. Okay, I will pause I will stop the backtest previous debugging session, and let me rerun. I wanna go here, and I wanna make sure that we start with the initial cash. Okay, so we have just added money to our trading account, and since the next day we will start trading, of course, depending on the level of the volatility. Okay, so to do the trading, I recommend that you use some sort of calendar. I will just make a calendar based on all the dates in the prices data frame. Prices index, and like I said, the very first day we just don't trade. We will skip that day. So I will say we just want to have all the days except for the first one. So I'm gonna skip the 0th index. Okay, and then we will be iterating over all days in the calendar for date in calendar. Do something. Yeah, if you see a loop in Python, it's always it might indicate that the code is not very efficient, and I'm not saying that this is efficient code, but it's just a code that is very easy to be understood. That's why I use it. We are going to find a previous date for a given date. So I will define previous date is equal to df init index df init index smaller than date, and I want to take the latest date. So just this looks relatively ugly. But if I show you what it does is, okay, I will rerun this thing. Okay, so we have some date. In this case, it's 4th of January 2000, and we want to find the previous date. So what I do is that I just have a look at this index, and I want to see all the days that are before this date. That's this smaller sign, and then I take the latest one. So there is just one date smaller than 4th of January, which is this date, and I take then I take it. If I wanted to see previous date with respect to 12th of January, then I would take this whole range of dates, and I would take the latest one. That's what the -1 is doing. Yeah. So here we can just test it's picking up the right date. Okay, so previous date was 3rd of January, and current date would be 4th of January. So this seems to be working fine. Then what we are going to do is that we are going to set that df init at the particular date is exactly a copy of the previous date. In other words, today in the morning we are starting with exactly the same portfolio that we had on the previous evening. Yeah, that's the idea. And we are going to need to know what's the value of our portfolio by the end of this date. So to calculate it, we will just define a variable portfolio value is equal to df df init lock date symbol trade times prices plus df init lock date cache. In other words, what we are doing here is that before we actually commit to something by the end of this date, we just want to know what's our portfolio worth, just like a second before we actually commit to something. Yeah, so just in an instant before we trade, we just want to know what's the value of our portfolio, and we know that the portfolio consists of some possibly ETF or stock position, which is which means we need to get number of pieces times their values, and we need to add the cash account. And then we are actually implementing already a trading strategy. So our trading strategy is that we are going to check if at particular date the volatility is greater than the volatility threshold, And if this is true, it means volatility is high. And be fully in cash. Otherwise, volatility is low. Be in ETF or let's say ETF or market position. No. So what we are going to do here is that we are going to say DF and lock date symbol trade is 0. In other words, we are saying, okay, if the volatility is really high, then we are going to have 0 position in the ETF by the end of the trading session. By the end of this trading day, we are going to have 0 ETFs. And all our portfolio will be moved to cash. So DF and lock date cash will be equal to our portfolio value, right? So everything that we had will be now stored in cash. If we had ETFs, we will just sell the ETFs and put the money to the cash account. Okay, so this was for the high volatility case. For the low volatility case, we'll just do the opposite. We want to hold no cash, so DF and lock date cash is equal to 0, right? And all the wealth will be stored in market position. That means we are going to hold the ETF. So DF and lock date no, not really this symbol trade will be equal to portfolio value over, and then we need to know prices lock date symbol trade. What we are doing here is that we are just saying, okay, if we have some value of a portfolio which consists possibly either from cash or from stocks, then we are going to hold this amount of ETFs by the end of the trading session. Yeah. So if we held cash by the beginning of the trading session, we will transform the cash into this position. And eventually we are going to see the difference between the end day and the beginning of the day. So we are going to calculate the difference. We'll do DF update, lock date. Oh, actually, don't need to add anything else. And we're going to DF and DF init lock date. Actually, I made a typo here. So this should be port value. I was referring to non-existent variable. Okay, so I think this is pretty much done. I will now have a look at whether it's doing something. We will see. Or maybe it would be easier to put the breakpoint here. Just let this all go through and then see what's how these data frames were filled in. All right, this might take a while because, like I said, it's not particularly fast code, but it's not horrible either. It's done, and we can now have a look at our trading strategy. So I think what really matters is the DFN, because it tells us what kind of positions do we hold by the end of each day. So you can see that we started with some cash and then we immediately bought the S&P 500 tracker. We can see that happened because the volatility was really lower than 30%. So we immediately took a position and we held the position. Then one day the volatility, it's 14th of April. Let's go to 14th of April. Yeah, the volatility jumped up a little bit over 30%. So we sold. This 104 or 105 ETFs, and we went to cash. And then the next day the volatility was again lower. And this way we can see what kind of what we are holding. And eventually you can also see that today when the volatility is really high because of coronavirus, we are not trading the ETF, and we are just staying in cash. And now we started with 10K, and now we have 18 or 19K. So eventually we have a profit. But what we are really interested in is the performance compared to the benchmark. So that's the S&P 500 with the symbol, and therefore we are going to add a few lines here that will just make this comparison. So first of all, we are going to define port. Well, so it will be data frame that will be having two columns. One will be the value of our trading strategy, and the other one would be the benchmark. And let's do it. So to do this, we will need to convert our end position into values. Okay. If I run this, I just want to show you before I do more, because there is some more to follow here. I just want to show you what I do here. So what we do is that we take our end of day positions in the ETF and in cash, and then we just want to see their values. me show you. Okay, so we knew we started with 10K. Okay, nothing really changes here, but then we went into the ETF, and the ETF, although we have the same position every day, the ETF is changing value, and based on the value change, also our portfolio value changes. So we just need to see the dollar value of our portfolio represented by this position in the stock and the cash. So what we are eventually going to do is that we are going to sum these two columns, because they will really tell us what was our portfolio worth by the end of each trading day. So that one is very easy. Okay. Going to make it the data frame and rename columns 0 to. If we do this summation, by default, Python will call the result column 0, but we just don't like that name. We just want to call it strategy. And the next column that we are going to add there, portfolio, will be a benchmark. And that will be just the S&P 500 that we will load by referring to the symbol benchmark. And there is one more step to follow. I will just firstly run this to show you. Okay, so it's done. And if I show you portfolio, something really went wrong here. I don't quite like this. Not sure really what happened here. We only want to have strategy and benchmark, not really any cash. We'll need to check what happened. Okay, that's something really strange. So let's go here. I now know the mistake that I made. We need to add a bracket here, because we just want to apply the sum to the result of this. Otherwise, the sum would be applied to this prices, blah, 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 something. And we are not interested in that one. We just want to sum the outcome of this. So once again, okay, let's see what's portfolio, and this looks much better. So this is the value of our strategy, and this is the value of the benchmark. And now it's a bit hard to compare, because each is just on a different scale. We started with 10K while the benchmark was 1.455. and that's quite hard to compare. So we will normalize all the values by the initial values. That means we will divide all this column by 10k, this whole column by 10k, and this whole column by this first value, so that both the trading strategy and the benchmark start at 1. Okay, port val is equal to port val divided by port val ilog 0 values. Okay, ilog will give us the first row, and values will just extract values from this pandas object. And then we are going to return this whole thing, and that's it. All right, we got something, and now it's really possible to compare how our trading strategy did against the benchmark, against the S&P 500. And you can see that the S&P 500 is doing a little bit better than us, but you might still want to prefer the strategy at some point, because it's not only about what you get at the end, but you might also want to take into account how resilient is your strategy to some market stress. Yeah, so for that we just want to see the plot. Okay, so here you can see, for example, that our strategy is behaving almost like S&P 500, but at some point it just doesn't take the dip. Here in 2008-2009 financial crisis, and our strategy is very resilient to the biggest dip. That means we would not lose money here if we just apply the strategy in that period. And also the same, I think, holds here, although we cannot see it directly. I think our strategy just takes less risk than the benchmark. You might want to see what happens if you decrease this to, let's say, 20. That means we'll be holding the S&P 500 tracker only when the volatility is relatively low, and you will see what kind of impact it would have on the trading strategy. And financial performance, of course. Okay, so here you can see that really we almost 2008 almost nothing would happen to us, because we would definitely lose some money, but much less than what the market lost. So in this case, our strategy would be far better in this period than how the market performed. And I believe also that would be more resilient to the coronavirus crisis that we currently have. We can see it here, or maybe we can just do a simple thing. So let's see just the latest year. Yeah, so in this picture you can see that in 2020, from the outbreak of the coronavirus, our strategy would just simply not trade. We would not take this dip. we would be fully in cash. That's why you get the flat line. Yeah. So what I want to say is that for the trading strategy, when you are assessing your trading strategy, it doesn't only matter whether you end up with a positive amount by the end, but it also depends on how you got there. What you want to do or what you want to see mostly is really like a steady growth. But in practice, that's really not achievable because there is always some market volatility. But you can just apply some rules of when you want to exit from the market and when you want to enter the market that can prevent your portfolio from losing money when the markets are very, very nervous. Yeah, so it's really important to take into account not just the final number here, but also how you got there. I think the most famous indicator that kind of takes this into account is Sharpe Ratio. In this case, we would be calculating something such as X post Sharpe. That means we know what happened, and then we just want to calculate, express it through some ratio. We just want to compare our return to the unit of risk taken. When I talk about risk, we usually mean volatility of return of our trading strategy. So I'm not going to go in detail here. I just want to say that to assess your trading strategy, you might not just want to have a picture like this, but you might want to calculate a ratio of this kind. Yeah, you can maybe assume away the risk-free rate. It's not as important those days because it's around zero anyways. So you would just compare the return, the realized return here with the volatility of this curve, and you would have to, I suggest that you use annualized numbers, and the bigger the ratio, the more you earn with respect to a unit of risk. So maybe the blue strategy, the trading strategy, would have a Sharpe ratio higher than actually the benchmark. So this is what you can also do to assess your trading. I think that would be pretty much it from my side. I hope that you learned something new. Maybe last word about this load equities thing. I suggest that you always load the equities once and then you use them, just like I do it. Because if you run this function very often, it might happen to you that Yahoo will block your IP address because you might be overusing the service. So please keep it limited. Just download the prices once and then play with the rest, in order not to get blocked from Yahoo Finance. This whole code I will upload to my GitHub repository. I will add the link to the description, and you are free to get the code there. Thanks for watching, and see you next time.